Wondering how ETFs can fit into your portfolio? Join us for our Spring into ETF Investing event, premiering May 12th and 26th. Check out these two exciting two-part events, which we curated specifically for you, the DIY investor. Our special guest speakers and insightful industry experts will provide you with the information and education you need to confidently manage your own portfolios. You won't want to miss these specials. Visit etfmarketinsights.com for more information. And remember to subscribe to our YouTube channel for fresh weekly content. Hit the alert button so you never miss a post. Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs, and today I'm joined by my colleague, Alfred Lee, Portfolio Manager here at BMO ETFs, no stranger to Market Insights. And today we're going to dig into how we can use ETFs as indicators for the market as a whole, and some advanced portfolio construction techniques as well. Before we get started, just a quick disclaimer and reminder, we're not providing you any advice or investment recommendations. Today's episode is about providing education for do-it-yourself investors around investing, around using ETFs. And a second reminder to please subscribe to our YouTube channel and ring that bell so that you're notified each and every Friday as future shows go live. I also wanted to highlight our website that goes along with our YouTube channel, etfmarketinsights.com, where you can find a ton of resources and tools for the do-it-yourself investor. So welcome, Alfred. I mentioned Alfred's a portfolio manager for our ETF desk, but he's also our BMO ETFs investment strategist. And last week, in case you missed it, we had the first of our quarterly portfolio strategy review podcast sessions. So I encourage you to check that out. Alfred has been running this portfolio for close to a decade now. And in these quarterly sessions, he's going to go through some of the tactical shifts that he's making and talk about the markets. So check that out. Today, Alfred is here to talk about how we can use ETFs as market indicators, as well as some advanced portfolio construction techniques. Alfred does hold his CMT, or his Chartered Market Technician designation, so he's going to be sharing some thoughts around technical analysis with us as well. So we've split this topic into two sessions. So this is part one, and we're going to start with equity ETFs. But broadly speaking, fund flows are a window into investor behavior, and they're often looked at as an indicator of investor sentiment. So today we're going to focus on equities, and then we'll have a second session around fixed income and alternatives. So stay tuned for that one. On this channel, at the beginning of the episode, sometimes I show you the flows of ETFs, and I have gotten the comment, why should we care about this? So today is a great spot for us to start and dig into that a bit more. But first, I wanted to show you where you can find these flows. So we love this National Bank ESG or ETF research report, sorry. And this comes out monthly. It's very in-depth, but also very easy to digest. And you can find this on the CETFA website, which I've linked here. And that's where you'll find it every month, and you can get these flows in your own hands. So Alfred, let's jump right into it. I promised we were going to look at why investors should be looking at these ETF flows and why they should care. So walk us through how we can actually use these and why ETFs are so effective.
Sure. So as you mentioned, fund flows are essentially a sentiment indicator. So a good thing about ETFs is that, in the last 10 to 15 years, we've seen a lot of ETFs and a lot of innovations in the ETF industry where, 15, 20 years ago, an ETF essentially tracked the broad market. But now you could get ETFs that track, specific parts of the market, not just the equity market, but also fixed income as well. So the good thing is that you can see where fund flows are going in specific parts of the market. So We have these heat maps available on our dashboard, for example, that show fund flows, for example. And you know, as you mentioned, fund flows are essentially almost like a sentiment indicator. It gives you confirmation in terms of, let's say, if you wanted to put on a trade in your portfolio, you could see where fund flows are going in order to get confirmation. So you think, you know, for example, you know, a quality ETF is potentially a good thing to buy right now. And if you see fund flows moving in that direction, it could give you a confirmation. In addition to that, some people will use it very differently, just in terms of using it as a contrarian indicator. So some people that think, you know, the market is always one step behind, and you know, they think that you know, the market or investors usually have it wrong. You could use it as a contrarian indicator. So let's say, for example, if you're holding a long federal bond, for example, long federal bond ETF, and then all of a sudden you see fund flows moving in that direction, that could give you indication of, you know, potentially reducing your position or just exiting the position as well. So very different ways in which you could use it. You could use it both for confirmation and a contrarian indicator, depending on how you invest. One thing I will highlight is that, you know, usually with fund flows or at certain times, there could be a lot of noise. For example, we do get a lot of institutional traffic in our ETFs, which sometimes can be used as an indicator, but sometimes they are investing for very different reasons, right? So sometimes our pension clients, for example, will be buying long-term bonds for liability matching, which isn't portfolio positioning. So there's a lot of noise going on at the end of the day. So that's one thing I would take caution with.
All right, and then from your perspective, what are sort of the most notable trends that you're watching right now in terms of the flows in equity ETFs?
It's a good question. So far, year to date, we've seen a lot of flows move back into international equities. So, for example, in this chart over here, you can see, you know, international equities, a lot of investors moving back towards that beta exposure. So going into ETFs like ZDM, which is our EFI ETF that's hedged back to the Canadian dollar. Also ZEA as well. But outside of that, just from a factor perspective on a global level, we see a lot of investors moving into quality, for example. Last year, quality underperformed just because of rising interest rates, and there's a little bit of technology exposure in the quality factor, but now as interest rates have started to level off, quality is starting to come back in terms of performance. So we've seen a lot of fund flows move in that direction as well. In fixed income, the number one fund flow has definitely been on the long federal side, just as we're going to talk about this a little bit later on, but the correlations between long federal bonds and the equity market are negative again. So we're seeing a lot of people, you know, start to use that as an equity hedge, but a lot of interest in terms of money market or money market type ETFs as well, just because the yield on a lot of these money market ETFs are comparable to a GIC, but the good thing is that they're not locked in as they would be with the GIC.
So what can they tell us about where we're at sort of in the market cycle, or how would you look at that in relation to these?
It really depends. I mean, I think, you know, right now with the Fed kind of leveling off interest rates, I think, you know, for the most part, that's been good for the equity markets and the bond markets. So last year, obviously, you know, with the Fed raising rates, that was bad for both asset classes. So we're definitely seeing a lot of interest in, you know, people taking on risk in their portfolios again, just moving back into equities and bonds, which has been very positive for fund flows, but also investors as well.
Okay, perfect. And I mentioned we're going to get into some technical analysis techniques and what to look for there. But first, give us some more like simple ways that we can look at trends in the market. You know, for example, here you did some work around inflation that I thought was interesting.
Sure. So one thing I will say is that, you know, when I first started in the industry, a lot of people, when they put together portfolios, they used individual securities. So diversified portfolio back in the day was, you know, 15 to 20 stocks, mostly Canadian stocks, maybe some US stocks sprinkled in there, and then some federal bonds on the fixed income side. But, you know, one thing that I've noticed in the last 10 to 15 years is that with the introduction of ETFs, a lot of investors are putting together portfolios more holistically, so using asset classes through ETFs rather than picking individual stocks. So, you know, with all the different ETFs, it does allow investors to build portfolios very similar to how institutions do. So a lot more diversified, a lot better constructed as well. So we've seen a shift in terms of people moving from bottom-up portfolio construction to top-down. So the big question is, how do you position a portfolio using top-down? So we look at certain things. So when you look at economic data right now, I would say, even though when you're looking at things like CPI, PCE, inflation is starting to trend down, which is a good thing, but inflation is still very top of mind with a lot of investors. The inflation rates right now still a lot higher than what central banks like to target. So the concern is, how do asset classes behave in certain inflationary environments? So obviously, when you pull data for the last 30 years, we haven't really seen an inflationary period. So what we did was we look at the 10-year break even, which is the market's expectation for inflation going forward. And then we just look at the day-to-day movement in that index and how each of these indexes, as represented by ETFs, behave in those different environments. So the top of the chart, or the top of this table here, is basically a deflationary environment. So you can see equities underperform here, bonds outperformed, commodities underperformed, and gold held in pretty well as well. The bottom of the chart, so the second from the bottom, that's an inflationary environment. So if you look at the relationships between the different asset classes, no surprise, you almost get the opposite behavior where equities outperform, bonds underperform because holding value is no longer good enough. You need some growth in your portfolios, and then commodities and gold outperformed as well. At the bottom of the table, that's what I would say a hyperinflationary environment. So a lot of the asset classes had a very tough time in holding up with inflation. So knowing all this insight, that could give you an indicator in terms of how to properly position a portfolio, which asset classes to overweight and which asset classes to underweight. And the good thing about ETFs now is that you could easily execute these views through one ETF, or using an ETF for each of the asset classes, where back in the old days when people were using individual stocks, it'd be very difficult to do so.
Yeah, ETFs have for sure revolutionized that portfolio construction ability and really come a long way. Common approach with technical analysis that you like to talk about is moving averages, and really looking at asset classes as they relate to each other. So walk us through this approach.
Sure. So if I put my technician hat back on, I would say, one of the best concepts that come out of technical analysis from my point of view is intermarket analysis. So intermarket analysis is essentially, the relationship between three major asset classes. So that's commodities, stocks, and bonds. And the reason why they look at that is because, each of those three asset classes are going to behave very differently depending on, what environment we're in. So in an inflationary environment, commodities are going to outperform. In a growth environment, equities are going to outperform. And in a deflationary environment, bonds are going to outperform. So, knowing the relationships between each of these three different asset classes will give us insight in terms of, which parts of our portfolio we potentially may want to overweight or underweight. So what we, or what investors can do is they could look at the relationships between each of these pairs. So stocks to bonds, for example, they can run this ratio. So anybody that's familiar with technical analysis will say, this is basically a relative strength ratio, which it is. So you can create a ratio between, stocks and bonds. And then on top of that, what you could do is you could overlay moving averages on top of that. So a 50-day moving average and a 200-day moving average. And then you could build, signals to tell you, let's say if the ratio moves above that 50-day moving average, you could start becoming a little bit more overweight one asset class to another. And then when the 50-day moving average moves above the 200-day moving average, that could tell you to move your maximum overweight one asset class to another. I mean, obviously these are just, simple rules. I wouldn't say that you build your portfolio based on these rules, just solely on these rules, but these are indications or indicators that you can use in terms of guiding you in your portfolio construction process.
And investors can do that. There's all the discount brokers have some technical analysis tools, I believe. And then of course there's tools like stock charts as well, where you can do this.
Yeah.
If you don't have a Bloomberg terminal like you, right?
Yeah, no, I would say, stock charts is actually very good. So a lot of these charts, I was just going to say, obviously we built these charts on Bloomberg. It's a little bit tough to see on this presentation here. But stock charts actually has a lot of these capabilities. And I would argue that even stock charts, in terms of the technical analysis indicators, is even a lot better than Bloomberg.
Do you want to walk through some of these charts in terms of commodities to stocks?
Sure. So very similar to the other ratio we looked at before. So these are just looking at the other pairs, commodities to stocks. So we know the relationships between inflation and growth. So that gives us an indication just in terms of how the economy is shifting, but also which asset classes to overweight relative to another. And again, the good thing is that with ETFs, it does allow us to have efficient vehicles that we could easily execute our views through one single trade.
For sure. And same thing here, commodities to bonds. Maybe we'll get into that in the next one, part 2.
Yeah.
All right, let's look at some other advanced techniques for portfolio construction, how we can build more effective portfolios by looking at things like correlation between different asset classes with ETFs. Walk us through this.
Sure. So correlation is very important, just because when you're building a portfolio, obviously you want to look for assets that are not correlated to one another. That essentially is one of the building blocks to portfolio construction. That's one of the main principles. So you want to build a portfolio with things that are not correlated. So one correlation that a lot of investors tend to look at is the relationship between the stock market and also things like long-term bonds and long-term U.S. Treasuries as an example of that. And the reason why is because usually, obviously the stock market will price in economic expectations. So anytime or when the economy starts to slow down and move into a recession, the stock market is going to price this in usually 6 to 9 months ahead of time. And then what happens is the bond market will also price this in. You usually get an inversion of the yield curve, so long bond yields start to go down in anticipation that the central banks will start to ease interest rates at some point in the future. So typically in that environment, as the central banks start to try to stimulate the economy by lowering rates, people move into long bonds in order to get that duration risk. So that negative correlation that usually happens is usually good equity market hedge. So people buy long bonds as a way to hedge their exposure to equities. In 2022, some of your listeners may point out that this didn't really work very well. And the reason why is because, when we got an equity market slowdown last year, it was a very different problem where we had inflation. So the playbook for the central bank wasn't to ease interest rates and make things worse. It was essentially to raise rates and slow down the economy. So that's why, when you look at the correlation at the bottom of this chart, this is basically just a rolling correlation between the S&P 500 and ZTL, which is our long-term U.S. Treasury. And anytime it's red, that's a negative correlation, which is good for good for portfolio building. That means it's a good hedge against the equity markets. But as you can see over here, lately it's been more green, meaning that it's positively correlated, which does not mean it's a good hedge. But in the last week, this chart is a little bit outdated now, but in the last week that's become negative again, which is the reason why a lot of investors are putting that hedge back on using things like ZFL, which is our long federal bond ETF. Because that negative correlation is back, they want to use that as a hedge against the equity market.
Absolutely, always good to keep an eye on that. All right, and then some investors like a particular factor, stick with that particular factor. Maybe they can't stomach the volatility in their portfolio and like a low volatility approach in all market cycles. But what are some more advanced ways of looking at factor ETFs in particular when it comes to portfolio construction?
Sure. So as you mentioned, people use factor-based ETFs strategically. So as you mentioned, if they don't want to stomach the volatility, they could go into a low vol ETF. So I would say those investors use factor-based ETFs more strategically. But we also have investors that use factor-based ETFs more tactically. So historically, certain factors will outperform or underperform depending on which part of the economic cycle we're in. So this chart over here, this chart is very good. I mean, this is very illustrative of how to use factor-based ETFs. This was provided to us by MSCI, but this compass on the left-hand side, I call this the economic compass. It's very familiar or very similar to what hedge funds like Bridgewater tend to use in terms of guiding their portfolio process. But what you'll find here is that there's two axes. There's inflation, which is either rising or falling, or there's economic growth, which is rising or slowing. So based on that, you can figure out where in the economic cycle we're in. So right now, I would argue that we're either in a stagflationary environment or a slow growth environment. So if you look at the table on the right, in a slow growth or a stagflationary environment, the three factors that tend to outperform are dividends, low volatility, and quality. Last year in 2022, obviously with the Fed raising rates, dividends and low volatility were the clear winners. But now as the Fed has started to back off on interest rate hikes, the quality factor is starting to come back quite a bit. So, if you wanted to focus tactically in terms of how to position your portfolio using factors right now, I would focus on, one of those three or a combination of those three.
Good segue. So you've done some analysis around combining the different factors in a portfolio and how that can be effective. So walk us through some ideas around that.
Sure. So I would say, holding three factors may be too much for a lot of investors. So you may think to yourself, which two factors do I want to hold in combination? And, obviously you want two factors that are going to be complementary to each other. For holding two factors that are too similar, it's not going to provide you with much benefits just because they're going to be too similar. They're going to outperform and underperform in the same kind of market scenarios. So we've done a lot of analysis just in terms of, which factors have exposures and, how they're tilted towards certain factors as well. So this white, the white bars over here is the factor tilts of ZUQ, which is our quality, US quality ETF, compared to ZSP, which is our S&P 500 ETF. So as you can see over here, quality is tilted towards certain factors. And then the purple dot is ZLU, which is our low vol US equity ETF. And the yellow one is our US dividend ETF. So as you can see, just because the yellow dots and the purple dots are very close together, that tells you that dividends and low vol are very similar. There's going to be slight differences. Obviously, dividends are going to pay a higher dividend, but they tend to be more mature companies. So I would argue because quality, based on this analysis, is much more different than dividends and low vol, I would combine quality with one of those other two. And I historically, low vol and quality have been a very good combination to have, especially, last year, low volatility outperformed when rates were rising. Then now as rates have started to level off, quality has started to outperform. So it's a good barbell that we've looked at and done a lot of studies on. So this combination over here, which is a great segue, we've done a lot of analysis just in terms of, as I mentioned, combining certain factors together. So low volatility and quality, for example, we have done a lot of analysis on this. So this is basically the back test on a 50% portfolio in ZLU, which again is our US low vol ETF, and 50% in ZUQ, which is our quality ETF. So over the long haul, very similar performance to the S&P 500. Annualized return is a little bit improved. Volatility is lower. Risk-adjusted return, which is the efficiency of the portfolio, better on the 50-50 portfolio. And where I think the real value starts to come in is the match drawdown. So you're minimizing those drawdowns when the market sells off, just because ZLU and ZUQ tend to be more defensive in nature.
Yeah, those look really, really good together. It's a good comparison there. And then same thing sort of goes with sectors. You can take that strategic approach and overweight energy or healthcare if you have conviction in those particular areas. But a more advanced technique would be a factor rotation strategy. So can you explain what this is?
Sure. I mean, a sector rotation strategies, it's been around for a very long time. It kind of predates ETFs. Kind of dating myself at this point, but when I entered the industry, when people use sector rotation strategies, they did it with 2 or 3 stocks that represented a certain sector. Now with ETFs, the good thing is that you can get exposure to those sectors by using an ETF, and it minimizes a lot of that company-specific risk. So with the sector rotation strategy, as you can see from this chart over here, where you have the 2 waves. The red wave is essentially the equity market. The blue wave is the economy. And as I mentioned before, the equity market tends to be forward-looking, so it tends to price in, recessions and expansions ahead of the actual economic cycle. But different sectors will outperform and underperform at different points of that economic cycle. So early recovery, for example, you could overweight things like financials, consumer discretionary, and real estate. Mid-cycle, it could be things like technology, industrials, and late cycles, more commodity-related sectors tend to do well, like energy and materials. And then, during a recession, you definitely want to be more overweight towards more defensive areas. Every economic cycle is going to be a little bit different, but those are the general patterns. One thing I would also highlight is, if you want to run a sector rotation strategy more based on, interest rates, for example, right now, a lot of investors are concerned about, is the Fed going to be raising rates? Or are they going to be pausing on interest rates? The market has rate cuts priced into, the market for later this year, which I don't know if is going to transpire or not, but we'll see. But what you can do is you could run a correlation between the 11 sectors and the US 10-year Treasury yield. So if you think interest rates are going to go up, you want to pick the sectors that are going to be positively correlated, such as energy and financials. And if you think interest rates are going to go down, you want to pick sectors that are going to be negatively correlated, such as utilities, real estate, and maybe technology as well.
That's great. In the mind of an investment strategist. And I love this image that we've created here, which showcases BMO's sector ETFs and sort of how they fit into that sector rotation wheel. Anything to add here, Alfred?
No, as I mentioned before, I think the innovation that we've seen in ETFs does allow investors to easily execute these views, as opposed to using individual stocks that exposes you to a lot of company-specific risk.
Yeah, it seems we're getting even more and more specific in our exposures too, with the recent launch of things like the Global Ag ETF, ZEET. You can really pinpoint different sectors, which is amazing. So thanks for that. We've covered off a lot, from how to analyze flows to some more advanced portfolio construction techniques. So I just want to turn to, we have 3 audience questions today. So the first one, will you be producing more French content? So I did see this comment on one of our latest videos, and I was happy to see it because we have recently launched our French ETF Market Insights website. So now all of the resources and tools available on our website are available in French now as well, so I encourage you to check that out. In addition, we have posted the first of a series of webinars we've done in partnership with Les Affaires onto our ETF Market Insights YouTube channel, and we'll continue to do so. So you'll see there's a French playlist now where you can access resources, but definitely looking to grow that out more as we keep going. Alfred, I'll give this one to you. Can you comment on the First Republic collapse and the impact to any of the BMO portfolios?
Sure. So First Republic, so for your listeners, for those that don't know, went into receivership over the weekend, so essentially went bankrupt. This is to follow other problems at other regional banks. So we saw that first with Silvergate, then with Silicon Valley, and then Signature Bank as well. So the ETFs that could have potentially helped these were more specifically our US bank ETFs, so ZBK, which is our equal weight US bank ETF, and ZUB, which is the currency hedge version. We also have our covered call US bank, which is ZWK. So we did not hold First Republic in those portfolios. We sold them on our last quarterly rebalance, which was back in March, so we no longer had exposure to First Republic, so we had no direct impact to the portfolios. The only concern now is that, obviously some of the concerns have bled over to some of the other regionals, but it has tended to benefit some of the larger US banks such as JP Morgan, Citibank, as a lot of the deposits have gone from the regionals to the larger money center banks.
For sure. Okay, thanks for that. And then last one, when is BMO launching an all-in-one covered call ETF? So we actually just filed for this last week, so I'll have more information as we get closer to listing, but very exciting. I know a lot of our viewers have been asking for this, and some of our competitors already have this. So the ticker is going to be ZWQT, so all covered call asset allocation ETF, if you will. So more to come on that in the coming weeks. All right, so thanks, Alfred, for joining me today, giving our viewers some insight into your world of advanced portfolio construction. For the next few weeks, we have our Spring into ETFs special edition episodes of Market Insights. So we have some fantastic hosts, including Jessica Morehouse from the More Money podcast and Sejal Patel from Strictly Money up next week, as well as a lineup of expert panels. So next week, panelists, I should say. Next week, we have a doubleheader. Episode 1 is focused on satellite ETFs to strengthen your portfolios. So Alfred, you'll be joining along with Andreas Rincon from TD. And the second episode is on passive management and building the case for index ETFs. So we will be digging into S&P's SPIVA data for that. It's for a very interesting session. Greg Walker from BMO and Graham McKenzie from the TMX will be the panelists on that show. So we will see you then. I hope you'll join us. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.